Hi everyone. My name is Brian, so how are you today? I hope you're feeling peachy because we're going to talk about Hong Kong's stock market boom of 2025 and cryptocurrencies today. Are you ready? Come on guys, you need to know about that. It's important, man. Come on guys. Sit down properly and fasten your seatbelt because we're about to take off. I've received 35 questions and I'll be able to answer them. You're all set, so let's get started. Question 1. What are the main reasons behind the recent rally in Hong Kong's stock market in June 2025? The recent surge in Hong Kong's market stems from a confluence of economic, geopolitical, and financial factors. First, the stabilization of global monetary policy, especially the end of aggressive interest rate hikes by the U.S. Federal Reserve, has restored investor confidence in liquidity and growth prospects. Second, China's policies have become more open, with measures favoring tech companies and foreign investment, making Hong Kong an attractive gateway into China. Third, the post-pandemic economic recovery has accelerated, driven by robust domestic demand and rising export levels. Fourth, improved diplomatic and trade relations between China and some international partners have reduced uncertainties, encouraging risk-taking behaviors. Overall, these factors have created a more favorable environment for investment, leading to increased bullish sentiment in Hong Kong's markets. Question 2. How is Hong Kong positioning itself as a hub for cryptocurrency and blockchain innovation amidst the recent market rally? Hong Kong has been actively positioning itself as a leading regional hub for cryptocurrency and blockchain innovation, capitalizing on its reputation as a global financial center and its relatively open regulatory environment. Over recent years, the city has implemented a progressive framework that encourages blockchain startups, crypto exchanges, and fintech firms to operate within a clear legal structure, fostering innovation while aiming to protect investors. The Hong Kong government and regulatory authorities, such as the Securities and Futures Commission, SFC, have taken measured steps to regulate digital assets without stifling innovation. For instance, the SFC has issued licenses for crypto exchanges that comply with anti-money laundering, AML, and Know Your Customer, KYC, standards, creating a regulated environment that attracts institutional players seeking legitimacy. Furthermore, Hong Kong has launched dedicated innovation labs, blockchain accelerators, and funding schemes to support startups working on decentralized finance, DeFi, tokenization, and digital asset management. The city has also seen the rise of digital securities issuance, with several companies conducting tokenized offerings, providing a bridge between traditional finance and blockchain technology. In the context of the recent market rally, this positioning enhances Hong Kong's attractiveness as a forward-looking financial hub capable of integrating conventional markets with emerging digital assets. It offers investors, entrepreneurs, and institutions opportunities to participate in cutting-edge financial products that could redefine asset management, trading, and investment strategies. However, challenges remain, such as the need for comprehensive regulation to prevent illicit activities, ensuring cybersecurity, and developing interoperability standards with mainland China's digital yuan initiatives. Overall, Hong Kong's proactive stance and strategic investments in blockchain infrastructure aim to solidify its role as an innovative crypto and blockchain center, complementing its traditional financial strength. Question 3. How does this rally in Hong Kong alter the traditional investor playbook for China? Traditionally, investors in China have adopted a cautious approach, favoring domestic markets or sectors considered more stable, while remaining vigilant about geopolitical and regulatory risks. The recent rally challenges this paradigm by prompting investors to reassess Hong Kong's potential as a more dynamic, less risky investment hub for Chinese assets. It raises questions about whether Hong Kong can now be seen as a more attractive platform for accessing Chinese growth, especially in sectors like technology and innovation. This shift may lead investors to diversify more boldly into Hong Kong-listed equities, balancing the risks with the rewards of exposure to China's evolving economy. In essence, the rally encourages a more proactive and risk-tolerant investment strategy, although investors must still remain cautious of potential regulatory and geopolitical shocks. Question 4. What are the implications for foreign investors seeking to access the Chinese market via Hong Kong? For foreign investors, The strong performance of Hong Kong's markets in 2025 presents a strategic opportunity to gain exposure to China while operating within a more transparent and well-regulated environment than the mainland. Hong Kong remains a global financial hub with strong legal protections, a sophisticated infrastructure, and deep liquidity, making it an attractive entry point. The rally reflects increased confidence in Hong Kong as a stable and vibrant financial center, which may encourage more international capital inflows. However, this dynamic also carries risks, such as increased volatility driven by global market fluctuations, geopolitical tensions, or regulatory shifts in China. Therefore, investors should approach with a balanced strategy, leveraging Hong Kong's advantages while carefully managing their exposure to potential risks. Question 5. How do international capital flows into Hong Kong influence the local market and perceptions of China? Massive inflows of international capital into Hong Kong bolster liquidity, elevate asset valuations, and increase market volatility in the short term. These flows also reinforce the perception of Hong Kong as a stable, attractive financial gateway to China, improving its image among global investors. This can encourage further foreign investments in Chinese companies listed in Hong Kong or in sectors linked to China's growth. However, such capital flows may also create imbalances if driven by speculative activities or short-term strategies. The overall perception of China benefits as well, viewed increasingly as an integrated and resilient part of the global financial system, though this depends heavily on China's political stability and regulatory environment. A sustained inflow signals confidence, but it must be supported by underlying economic fundamentals. Question 6. Which sectors are the biggest beneficiaries of this rally in Hong Kong, and why? The sectors most benefiting from this rally are primarily technology, finance, and consumer-related industries. The technology sector benefits from China's strategic push to bolster its national champions and attract foreign investment in innovation-driven companies listed in Hong Kong. The financial sector experiences a surge in trading activity, asset management, and banking services, driven by increased liquidity and renewed investor confidence. Real estate, especially commercial and residential properties, also benefits from this optimism as demand and investment activity pick up. Finally, consumer goods and luxury brands see growth due to rising domestic consumption and the influx of foreign capital seeking diversified opportunities. These sectors exemplify the broader economic recovery and investor enthusiasm fueled by the rally. Question 7. What are the potential risks or obstacles that could temper this bullish trend? Despite the optimistic outlook, several significant risks could hinder or reverse this rally. Geopolitical tensions remain a major concern. Ongoing conflicts or diplomatic disputes between China and Western nations could create instability and reduce investor appetite. Regulatory uncertainty in China, especially in tech and finance sectors, poses another risk. Sudden policy shifts or crackdowns could lead to losses and market corrections. A slowdown in the global economy or a decline in demand from major trading partners would also impact China's growth trajectory. Additionally, internal issues such as rising inflation, debt levels, or economic imbalances could threaten financial stability. Finally, a sudden market correction or financial crisis within Hong Kong could undermine current gains, emphasizing the importance of cautious risk management. Question 8. How does China's monetary policy influence this rally, and what are the medium-term prospects? China's monetary policy plays a pivotal role in supporting this rally. The People's Bank of China, PBOC, has maintained an accommodative stance with low interest rates and ample liquidity injections, fostering investment and consumption. This supportive monetary environment helps sustain the upward momentum in Hong Kong's markets. Looking ahead, if China continues to stimulate its economy while carefully managing debt and financial risks, this positive momentum could persist. Conversely, if inflationary pressures increase or macroeconomic imbalances tighten, the PBOC might tighten monetary policy, which could slow or halt the rally. The key to sustaining growth will be a delicate balance, supporting economic expansion without fueling bubbles or creating systemic risks. Question 9. How are Hong Kong's regulatory and corporate governance frameworks evolving to support this growth? Hong Kong has strengthened its regulatory environment to ensure transparency, investor protection, and adherence to international standards. The Securities and Futures Commission, SFC, has implemented strict measures to oversee market conduct, combat manipulation, and improve corporate governance. These reforms aim to bolster investor confidence, especially among foreign stakeholders. Moreover, Hong Kong's regulatory standards are increasingly aligned with global best practices, fostering trust and stability. The city has also integrated more closely with Chinese regulatory frameworks, facilitating cross-border cooperation. These evolutions are crucial for sustainable growth, as they help prevent excesses and systemic risks, making the market more resilient and attractive to long-term investors. Question 10. What investment strategies are recommended to capitalize on this trend in Hong Kong? To capitalize on this bullish trend, investors should adopt a diversified approach focusing on sectors benefiting most from current momentum, namely technology, finance, and consumer discretionary. Investing through ETFs or index funds listed in Hong Kong offers broad exposure and liquidity, suitable for risk mitigation. Active management can identify high-growth or undervalued companies within these sectors, especially amidst volatility. It's also advisable to incorporate macroeconomic analysis to anticipate policy shifts or market corrections. Risk management strategies, such as hedging or stop-loss orders, are essential given potential short-term fluctuations. Finally, maintaining flexibility and staying informed about geopolitical developments and regulatory changes will enable investors to adapt their positions effectively. Question 11. What are the potential risks and regulatory challenges associated with the expansion of cryptocurrency activities in Hong Kong? While Hong Kong's initiatives to promote crypto and blockchain innovation are promising, they come with significant risks and regulatory challenges that could impact the sustainability of this growth. First, the volatile nature of cryptocurrencies poses inherent risks, including market manipulation, price crashes, and exposure to speculative bubbles. The lack of global consensus on regulation creates jurisdictional arbitrage opportunities, where illicit actors could exploit less regulated environments. Regulatory challenges include balancing innovation with investor protection. The Hong Kong authorities must develop comprehensive frameworks that prevent money laundering, terrorist financing, and fraud, all while enabling legitimate businesses to thrive. The SFC's licensing regime for crypto exchanges exemplifies this effort, but enforcement and supervision remain complex, especially as technology evolves rapidly. Cybersecurity is another critical concern. Crypto exchanges and digital asset platforms are attractive targets for hacking and cyber attacks, which could lead to significant financial losses and damage to Hong Kong's reputation. Ensuring robust cybersecurity measures and incident response protocols is essential. Furthermore, regulatory ambiguities around the classification of digital assets, whether as securities, commodities, or other instruments, can hinder innovation or create legal uncertainties. This impacts issuers of tokenized securities, DeFi platforms, and custodians. Finally, the potential for regulatory overreach or sudden policy shifts might stifle innovation or drive activities underground, undermining Hong Kong's strategic position. Striking the right balance requires ongoing dialogue between regulators, industry players, and international partners, along with adaptive regulatory frameworks that can evolve with technological advances. Question 12. How could the integration of cryptocurrencies into Hong Kong's traditional financial system influence its market stability and investor confidence? The integration of cryptocurrencies into Hong Kong's traditional financial system has the potential to significantly influence both market stability and investor confidence, with nuanced effects. On one hand, embracing digital assets can enhance market efficiency, liquidity, and access, attracting institutional investors, hedge funds, and tech-savvy retail traders. The development of regulated crypto exchanges, digital asset custodians, and tokenized securities can create a more diversified and resilient financial ecosystem. However, this integration also introduces new vulnerabilities. Cryptocurrencies are inherently volatile, and their rapid price swings can spill over into broader markets, especially if large institutional positions are involved. If not adequately managed, this volatility could lead to sudden market shocks, impacting investor confidence and financial stability. Furthermore, the interconnectedness of traditional and digital finance necessitates robust risk management and oversight. If the regulatory framework is perceived as too lax, it could invite fraud, market manipulation, and systemic risks. Conversely, overly restrictive policies might hinder growth and innovation. Investor confidence hinges on transparency, security, and regulatory clarity. Hong Kong's commitment to establishing a well-regulated digital asset ecosystem through licensing, AML standards, and cybersecurity protocols aims to build trust. The city's reputation as a safe, transparent financial hub will determine whether integrating cryptocurrencies bolsters or undermines its stability. In the long term, responsible integration with clear regulatory oversight can position Hong Kong as a leader in digital finance, fostering innovation while maintaining market stability. Question 13. What are the implications for Hong Kong's role as a financial center in relation to the rest of the world? Hong Kong's emergence as a more vibrant and resilient financial hub reinforces its role as a key bridge between China and global markets. It is poised to attract more international investors, multinational companies, and asset managers, solidifying its position as an Asian financial gateway. This development could accelerate innovations in derivatives markets, fintech, and asset management services. However, maintaining this status will require Hong Kong to sustain a stable, transparent, and internationally compliant regulatory environment. Balancing its relationship with China while preserving its legal independence and rule of law will be critical. The city's ability to adapt to evolving global standards and geopolitical realities will determine whether it can continue to thrive as a leading global financial center amid increasing competition from Singapore, Shanghai, and other regional hubs. Question 14. How might geopolitical tensions between China and Western countries impact Hong Kong's market rally in the coming years? Geopolitical tensions have historically played a significant role in shaping Hong Kong's financial environment due to its strategic position as a bridge between China and the rest of the world. In the current context, escalating conflicts, such as trade disputes, sanctions, or diplomatic confrontations, could introduce increased volatility and uncertainty. If tensions intensify, foreign investors might become more risk-averse, leading to capital outflows or reduced inflows, which could dampen market momentum. Conversely, if tensions stabilize or de-escalate, investor confidence could be restored, allowing the rally to continue. Moreover, geopolitical frictions could influence regulatory policies, cross-border cooperation, and access to markets, potentially restricting some investment flows or increasing compliance costs. In the medium to long term, Hong Kong's ability to navigate these tensions diplomatically and maintain its open financial environment will be crucial to sustaining its growth trajectory. Question 15. What role do technological innovation and digital finance play in the current growth of Hong Kong's stock market? Technological innovation and digital finance are central to Hong Kong's recent market growth. The city has positioned itself as a fintech hub, fostering the development of digital banking, blockchain, and securities trading platforms. In particular, Hong Kong's regulatory environment has become more accommodating to innovative financial products, attracting startups, established tech firms, and international investors. The Hong Kong Stock Exchange, HKEX, has launched new listings and trading mechanisms for digital assets, such as tokenized securities and cryptocurrencies, aligning itself with global trends. These developments facilitate more efficient, transparent, and accessible markets, drawing a broader base of investors, especially younger and tech-savvy demographics. As China's digital economy expands, Hong Kong's role as a bridge for tech and digital finance innovation becomes increasingly vital, supporting the broader economic recovery and stock market rally. Question 16. How does the current rally affect Hong Kong's real estate market, and what are the potential risks involved? The rally has positively impacted Hong Kong's real estate sector, with increased investor confidence driving up property prices and transaction volumes. Commercial real estate, particularly office spaces and retail outlets, benefits from renewed optimism among local and international businesses. Residential property prices have also seen upward momentum as affluent investors and expatriates seek stable assets amid global uncertainties. However, This rapid appreciation raises concerns about affordability and potential overheating, which could lead to a bubble if speculative activity dominates. Additionally, tighter macroprudential policies or regulatory measures aimed at cooling the market might be introduced if authorities perceive signs of excessive risk. Over-reliance on real estate as an investment vehicle could expose the economy to significant vulnerabilities if market sentiment shifts or external shocks occur, emphasizing the importance of balanced growth strategies. Question 17. What are the implications of Hong Kong's stock market rally for China's broader economic reforms and policy direction? The rally signals a possible shift in China's approach to economic reform, emphasizing greater openness, market liberalization, and international integration. It suggests that the Chinese government recognizes the importance of Hong Kong as a financial gateway and is willing to support initiatives that bolster its global competitiveness. This could lead to further reforms aimed at streamlining regulations, enhancing corporate governance, and attracting foreign investment. Additionally, the rally demonstrates the effectiveness of China's dual circulation strategy, which seeks to balance domestic growth with increased openness to global markets. If sustained, this positive market sentiment could incentivize policymakers to accelerate reforms in sectors like technology, finance, and innovation. Conversely, policymakers must carefully manage risks associated with speculative bubbles or regulatory overreach to ensure sustainable economic growth. Question 18. How might the increased focus on ESG, environmental, social, and governance factors influence investment in Hong Kong's stock market? The growing emphasis on ESG factors is transforming investment strategies worldwide, and Hong Kong is no exception. Investors are increasingly demanding sustainable, socially responsible, and well-governed companies, which influences capital allocation decisions. Hong Kong's stock market has seen a rise in ESG disclosures, with regulators encouraging listed companies to improve transparency and adopt sustainable practices. This trend attracts institutional investors, asset managers, and pension funds seeking ESG-compliant assets, potentially driving higher valuations for such companies. Furthermore, ESG considerations can mitigate risks related to environmental liabilities, social unrest, or governance failures, making stocks more resilient over the long term. As ESG standards become more entrenched, companies that proactively embrace sustainability are likely to outperform, creating a shift in investment patterns that supports the longer-term growth and stability of Hong Kong's market. Question 18. How might the increased focus on ESG, environmental, social, and governance factors influence investment in Hong Kong's stock market? The growing emphasis on ESG factors is transforming investment strategies worldwide, and Hong Kong is no exception. Investors are increasingly demanding sustainable, socially responsible, and well-governed companies, which influences capital allocation decisions. Hong Kong's stock market has seen a rise in ESG disclosures, with regulators encouraging listed companies to improve transparency and adopt sustainable practices. This trend attracts institutional investors, asset managers, and pension funds seeking ESG-compliant assets, potentially driving higher valuations for such companies. Furthermore, ESG considerations can mitigate risks related to environmental liabilities, social unrest, or governance failures, making stocks more resilient over the long term. As ESG standards become more entrenched, companies that proactively embrace sustainability are likely to outperform, creating a shift in investment patterns that supports the longer-term growth and stability of Hong Kong's market. Question 19. How does the increasing integration of Hong Kong's financial markets with mainland China influence the city's regulatory landscape? The integration of Hong Kong's markets with mainland China has led to a gradual convergence of regulatory standards, with increased coordination to facilitate cross-border capital flows and trading. Initiatives like the Stock Connect and Bond Connect programs exemplify this trend, allowing easier access for investors on both sides. Consequently, Hong Kong's regulatory agencies are adapting to align with mainland policies, while maintaining its own legal and operational frameworks. This integration enhances market efficiency but also introduces new risks, such as exposure to mainland regulatory changes or policy shifts. It necessitates a delicate balancing act, preserving Hong Kong's reputation for transparency, rule of law, and investor protection, while accommodating China's regulatory sovereignty. In the long run, this harmonization could strengthen Hong Kong's role as a global financial hub, provided it maintains high standards and safeguards market integrity. Question 20. What are the long-term prospects for Hong Kong as a global financial center amid rising regional competition? Hong Kong's long-term prospects depend on its ability to adapt to regional competition from centers like Singapore, Shanghai, and others. While Singapore has positioned itself as a fintech and wealth management hub, and Shanghai increasingly attracts mainland corporations, Hong Kong retains unique advantages. Its legal system, international financial infrastructure, and reputation for transparency. To sustain its leadership, Hong Kong must continue innovating, embracing digital finance, expanding its financial products, and deepening cross-border cooperation with China and global markets. Maintaining political stability, rule of law, and a business-friendly environment remains critical. Moreover, the city's ability to balance its relationship with mainland China while preserving international standards will shape its future role. With strategic reforms and investments, Hong Kong can remain a vital, global financial hub for decades to come, especially as China's economy continues to open up. Question 21. How does the current market rally influence Hong Kong's attractiveness for startup funding and venture capital? The rally enhances Hong Kong's appeal as a startup hub and attracts venture capital by demonstrating investor confidence and market vitality. Increased liquidity, higher valuations, and a more favorable regulatory environment encourage both local and international startups to raise capital through the stock exchange or private funding. The city's strategic location and its role as a gateway to China's vast consumer market further bolster its attractiveness. Additionally, government initiatives aimed at fostering innovation, such as tech parks, grants, and regulatory sandbox programs, complement the market rally. Question 20. What are the long-term prospects for Hong Kong as a global financial center amid rising regional competition? Hong Kong's long-term prospects depend on its ability to adapt to regional competition from centers like Singapore, Shanghai, and others. While Singapore has positioned itself as a fintech and wealth management hub, and Shanghai increasingly attracts mainland corporations, Hong Kong retains unique advantages. Its legal system, international financial infrastructure, and reputation for transparency. To sustain its leadership, Hong Kong must continue innovating, embracing digital finance, expanding its financial products, and deepening cross-border cooperation with China and global markets. Maintaining political stability, rule of law, and a business-friendly environment remains critical. Moreover, the city's ability to balance its relationship with mainland China while preserving international standards will shape its future role. With strategic reforms and investments, Hong Kong can remain a vital, global financial hub for decades to come, especially as China's economy continues to open up. Question 21. How does the current market rally influence Hong Kong's attractiveness for startup funding and venture capital? The rally enhances Hong Kong's appeal as a startup hub and attracts venture capital by demonstrating investor confidence and market vitality. Increased liquidity, higher valuations, and a more favorable regulatory environment encourage both local and international startups to raise capital through the stock exchange or private funding. The city's strategic location and its role as a gateway to China's vast consumer market further bolster its attractiveness. Additionally, government initiatives aimed at fostering innovation, such as tech parks, grants, and regulatory sandbox programs, complement the market rally. This environment creates opportunities for entrepreneurs and investors to collaborate on innovative projects, particularly in fintech, biotech, and green tech. However, sustained growth depends on ongoing support for startups, talent retention, and maintaining a favorable regulatory framework to ensure Hong Kong remains competitive in the global innovation ecosystem. Question 22. What potential impact could a slowdown in China's economic growth have on Hong Kong's stock market rally? A slowdown in China's economic growth could pose a significant risk to Hong Kong's rally, given its close economic ties and reliance on China's demand. Reduced growth in China could lead to lower corporate earnings, decreased investment inflows, and diminished market confidence in Hong Kong-listed Chinese companies. It could also trigger capital outflows if investors seek safer or more stable assets elsewhere. Additionally, a slowdown might prompt policymakers to tighten liquidity or implement measures that could dampen market sentiment. While Hong Kong's diversified financial ecosystem could cushion some shocks, the city's growth prospects remain closely linked to China's economic trajectory. To mitigate this risk, Hong Kong needs to diversify its economy further, foster innovation, and strengthen its role as a financial intermediary beyond just China-related assets. Question 23. How might technological developments like AI and big data analytics influence Hong Kong's future market development? Technological advances in AI and big data analytics are poised to revolutionize Hong Kong's financial services sector. These tools enable more sophisticated trading algorithms, real-time risk management, and enhanced market surveillance, which can improve market efficiency and transparency. AI-driven analytics can help investors identify opportunities, assess risks, and make more informed decisions faster than ever before. For Hong Kong, adopting these technologies can attract global asset managers, fintech startups, and institutional investors looking for cutting-edge financial infrastructure. Moreover, AI can facilitate regulatory compliance, anti-fraud measures, and investor protection, strengthening market integrity. As these technologies mature, Hong Kong's financial markets could become more resilient, inclusive, and competitive on the global stage, reinforcing its position as a leading financial hub in the digital age. Question 24. How do currency fluctuations and Hong Kong's monetary policy influence foreign investment flows into its stock market? Currency stability and monetary policy are critical factors shaping investor confidence in Hong Kong's stock market. As Hong Kong operates under a linked exchange rate system pegged to the US dollar, its currency remains relatively stable, which is attractive to foreign investors seeking predictability. However, fluctuations in the USD or shifts in US monetary policy, such as interest rate hikes or cuts, can indirectly impact Hong Kong's monetary environment. For instance, a strengthening US dollar may lead to capital repatriation or outflows from Hong Kong equities, especially if investors seek higher yields elsewhere. Conversely, accommodative policies, such as low interest rates, encourage capital inflows, supporting market growth. The Hong Kong Monetary Authority, HKMA, closely monitors these dynamics, balancing currency stability with financial stability. In the context of the recent rally, stable currency conditions and an accommodating monetary stance have fostered a conducive environment for foreign investment, but ongoing global economic shifts could alter these flows. Question 25. What are the social and political implications of Hong Kong's stock market rally for its residents and governance? The recent rally in Hong Kong's stock market has several social and political ramifications. Economically, increased market activity can boost confidence among residents, create jobs, and improve living standards through higher wealth levels. However, rapid asset price appreciation might also exacerbate inequality, making housing and investment less accessible to lower-income residents. Politically, the rally signals a perception of stability and resilience, reinforcing Hong Kong's image as a global financial hub. Nevertheless, underlying tensions related to governance, civil liberties, and relations with mainland China persist. If the economic benefits are perceived as unevenly distributed or if social grievances deepen, political stability could be challenged. Conversely, economic growth driven by a vibrant market can bolster legitimacy for governance, provided that authorities address social equity concerns. The challenge lies in ensuring that economic gains translate into broader social stability. Question 26. How could Hong Kong leverage its financial sector to support China's Belt and Road Initiative (BRI)? Hong Kong can play a strategic role in supporting China's BRI by serving as a financial intermediary facilitating cross-border investments, project financing, and trade finance. Its sophisticated financial infrastructure, legal system, and international connectivity position it well to channel foreign capital into BRI projects across Asia, Africa, and Europe. Hong Kong-based banks and financial institutions can issue bonds, provide project loans, and develop infrastructure investment funds aligned with BRI objectives. Additionally, Hong Kong can host platforms for BRI-related fintech innovations, digital currencies, and trade logistics. By positioning itself as a financial hub for BRI projects, Hong Kong can attract institutional investors and multinational corporations, fostering economic integration and regional development. To maximize this potential, Hong Kong must ensure regulatory clarity, foster transparency, and build strong partnerships with Chinese authorities and international stakeholders. Question 27. How might demographic changes in Hong Kong influence its stock market and economic outlook? Hong Kong faces demographic challenges such as an aging population, declining birth rates, and potential talent shortages. These trends could impact its economic growth by reducing the labor force, increasing social welfare costs, and constraining domestic consumption. A shrinking workforce might limit the expansion of certain sectors, such as real estate and retail, while increasing dependency ratios. Conversely, an aging population could boost demand for healthcare, biotech, and senior services, presenting new investment opportunities. The government's response, such as policies on immigration, talent attraction, and technological innovation, will be pivotal. A proactive approach can mitigate negative demographic effects, ensuring sustained economic vitality. For the stock market, demographic shifts will influence sector performance, investor sentiment, and the types of companies that attract capital. Question 28. How do Hong Kong's legal and regulatory frameworks support or hinder innovation and startup growth? Hong Kong's legal framework is rooted in common law, providing a stable and transparent environment that supports innovation. Its intellectual property protections, contract enforcement, and business-friendly regulations promote startup development. The government has launched initiatives like innovation hubs, funding schemes, and regulatory sandboxes to encourage fintech, biotech, and green tech startups. However, challenges remain, such as high operational costs, limited access to venture capital compared to other regions, and regulatory uncertainties in emerging technologies like crypto and AI. While Hong Kong's legal environment generally fosters entrepreneurship, the city must continue refining its policies, streamline procedures, and enhance access to funding to remain competitive globally. Strengthening its innovation ecosystem will be crucial in sustaining long-term growth amid regional competition. Question 29. To what extent does Hong Kong's financial success depend on China's domestic policies and economic health? Hong Kong's financial prosperity is heavily intertwined with China's economic performance and policy environment. As a major offshore financial center for Chinese companies, Hong Kong benefits from mainland reforms, capital inflows, and its role as a conduit for foreign investment into China. China's policies on opening markets, financial liberalization, and technological innovation directly impact Hong Kong's growth prospects. Conversely, restrictive policies, capital controls, or economic slowdown in China can reduce cross-border flows, dampen market confidence, and slow down Hong Kong's financial momentum. The city's future depends on its ability to adapt to China's evolving policy landscape, maintain regulatory standards, and continue attracting international capital, all while supporting China's strategic economic objectives. Question 30. How does Hong Kong's educational and talent development system influence its financial sector's future competitiveness? Hong Kong's education system, renowned for its quality, plays a vital role in maintaining a talented workforce for its financial sector. The city produces skilled professionals in finance, law, technology, and management, attracting international talent due to its global connectivity and high living standards. However, demographic challenges and competition from other regional hubs like Singapore and Shanghai necessitate continuous upgrades in education, vocational training, and immigration policies. Investment in STEM, science, technology, engineering, mathematics, education, language skills, and innovation-driven curricula is essential to sustain a competitive edge. Developing a diverse, adaptable talent pool will enable Hong Kong's financial sector to adopt new technologies, expand into emerging markets, and maintain its global leadership position amid evolving industry demands. Question 33. What is the outlook for Hong Kong's financial markets in a post-pandemic world, considering ongoing global uncertainties? the outlook for Hong Kong's financial markets remains cautiously optimistic. The city's resilience during the pandemic showcased its ability to adapt through digital transformation, diversified revenue streams, and strong regulatory frameworks. Moving forward, Hong Kong's markets will benefit from global economic recovery, China's continued growth, and technological innovation. Nonetheless, persistent uncertainties, such as geopolitical tensions, potential trade restrictions, and macroeconomic shocks, pose risks. The city's success will depend on its ability to foster a stable political environment, maintain regulatory standards, and leverage its strategic position to attract international capital. A focus on sustainable growth, technological advancement, and inclusive policies will be key to ensuring Hong Kong remains a vital global financial hub in the evolving post-pandemic landscape. Question 34. What role could Hong Kong's digital yuan, or central bank digital currency, CBDC, play in the broader cryptocurrency landscape and its impact on the market rally? Hong Kong's engagement with China's digital yuan, ECNY, a central bank digital currency, CBDC, could significantly influence its cryptocurrency landscape and the ongoing market rally. As China advances the development and deployment of the digital yuan, Hong Kong's proximity and financial integration make it a strategic testing ground and pilot zone for CBDC applications. The digital yuan offers several advantages: enhanced cross-border payment efficiency, reduced transaction costs, and increased monetary sovereignty. If Hong Kong adopts or integrates the digital yuan into its financial ecosystem, it could facilitate seamless cross-border transactions with mainland China, boosting trade and investment flows. This, in turn, could strengthen Hong Kong's position as a regional financial hub and support the broader market rally by increasing transaction volumes and attracting new participants. Moreover, the coexistence of the digital yuan with private cryptocurrencies and stablecoins could create a diverse digital currency ecosystem, fostering innovation and competition. Hong Kong's regulatory clarity and infrastructure could enable the development of hybrid solutions, such as tokenized assets linked to the digital yuan, further expanding investment options. However, the adoption of the digital yuan also raises concerns about monetary sovereignty, surveillance, and privacy. It might also influence the global perception of Hong Kong's financial independence if China's CBDC becomes dominant in the region. In summary, the digital yuan's integration into Hong Kong's financial system could reinforce its role as a bridge between traditional finance and digital currencies, potentially fueling the ongoing market rally and shaping the future of digital assets in the region. Question 35. How might the evolution of decentralized finance, DeFi, platforms in Hong Kong influence traditional banking and asset management industries? The rise of DeFi platforms in Hong Kong could fundamentally reshape traditional banking and asset management industries by introducing new models of financial intermediation that operate without centralized institutions. DeFi leverages blockchain technology, smart contracts, and tokenization to facilitate peer-to-peer lending, trading, asset management, and insurance, all in a decentralized manner. For Hong Kong, a city with a well-established financial infrastructure, DeFi presents both opportunities and threats. On one hand, DeFi can democratize access to financial services, reduce operational costs, and foster innovation. For example, retail investors could gain access to yield-generating protocols, or institutions could participate in decentralized liquidity pools, diversifying their investment strategies. On the other hand, DeFi's emergence could challenge traditional banks and asset managers by eroding their market share, reducing fee income, and increasing competition. The transparency and programmability of DeFi platforms could lead to more efficient, automated services, which might be perceived as superior by tech-savvy clients. Regulatory responses will be crucial. Hong Kong's authorities are exploring frameworks to regulate DeFi, aiming to harness its benefits while managing risks such as security breaches, fraud, and systemic failures. The integration of DeFi into the mainstream will likely lead to hybrid models, where traditional institutions incorporate DeFi elements such as tokenized assets, decentralized exchanges, and smart contract-based products, enhancing their offerings. Ultimately, the evolution of DeFi in Hong Kong could lead to a more flexible, efficient, and inclusive financial ecosystem, but it requires careful regulation, technological innovation, and industry collaboration to mitigate risks and unlock its full potential. That's all for today. I hope you've learned a lot today about today's theme. We'll meet up again some other time. Cheers.